All right. Well, I guess I see a few more faces today, although it's like some people decided Tuesday or Thursday was going to work this week. All right, so if you weren't here Tuesday, hopefully you were able to look at what I posted, the lecture, or you just understood the material through reading and doing the homework on your own. I probably shouldn't tell you guys this, but I either have, I don't know if I have for this class, or will mark everyone here attendance-wise Tuesday, even if you weren't. And there actually will be probably, I know of at least one other time in the next couple weeks, and there probably will be more times, maybe one or two the semester long, where I'll ask you to come on a Tuesday. Those days, I would obviously encourage you to show up if you want. I will be here even if no one else is and lecture. But on those days, any day I ask you to come on a Tuesday, I'll mark everyone here, even if you don't show up, and I'll post a video. So I want you guys to have that as a flexible day. Other than, of course, I did want to remind you that for the midterm and final, Tuesdays will be mandatory, okay? Just because it will take 2 full class days to do the test. Okay, so for today, we're just going to go through these quiz-like questions. Again, as has been typical in the past, when I do these, if there are several questions on the quiz that cover pretty much the exact same principle, I won't do several questions on the walkthrough. But I think there's really only 1 or 2 questions on the quiz that were pretty identical. So anyway, like has been the case in the past, if you can understand and do well on what I explained today, you should have no problem doing well on the quiz. I know at least a few of you have already taken the quiz at least once. I didn't really dig deeper than that. But of course, since you have multiple attempts, if you took it once and weren't happy with your score, hopefully this will help you understand what you missed. Okay, question 1. Treble Corp issues $950,000 of 10-year bonds with a stated rate of interest of 10%. The market rate on the date of issuance is 15%, and so the bonds are sold at a discount. Which of the following statements is true? Obviously, you don't see any statements there. Okay, I put that question, which of the following statements is true, because on that one, on the quiz-like one that this is similar to, that I pulled it from, that's what it's asking you. But it's basically taking the information from the question and giving you a kind of a few-word factoid about this information you're given. And one of them is true, and the rest of them are false. So the easiest way for me to understand those questions is, as long as you just understand what all the numbers in the information and the facts mean, then you should have no problem telling me which one of these is true. So what that means for this question, Treble Corp issues $950,000 of 10-year bonds with a stated rate of interest of 10%. That means that if the market and the stated rate were the same, Treble Corporation would be receiving $950,000 cash from whoever's buying the bonds. Okay, that's why they're selling them, so they get the cash up front. They're borrowing that money. Okay, and then they would have to pay. Treble Corp would have to pay interest payments. And let's see, I don't have it in this fact, but let's just assume that these are semi-annual interest payments. So twice a year, assuming the market was the same as what's stated on the bond, twice a year you would have 5% times 950,000. That much interest would be paid by Treble Corp to whoever bought these bonds. Okay, that's if the market and the stated rate were the same. In this case, that's not what happened. So, since the market rate is 5% higher than what's on the bonds, what that means is no one would buy our bonds in exchange for 10% interest. when they could go into the market and give 15%. So we have to issue these bonds at a discount. So what that means, and you're not given the exact amount in this question, but what that means is instead of someone giving us $950,000 today for these bonds, we're going to have to make up the difference between the market rate and what's on these bonds in an upfront discount. Okay, so instead of them giving us $950,000, they would give us something less. In this case, quite a bit less, since the interest rate is so much lower. So let's say maybe $700,000. So they give us $700,000 today. 10 years from now, we have to pay them back $950,000. So even if we didn't even look at other interest payments throughout the term of the loan, we're already having to pay them back $250,000 more than they paid us, and that whole discount is in basically a different way of phrasing the interest that we're paying in exchange for this money. So it's basically making up the difference. So some of those statements that you'd be looking for in this question would be, I may say, Treble Corp in this scenario has to pay 10% of interest a year on $950,000 as the principal. Is that true? Yes, it is, because whatever the stated rate on the bond is, that's what you're paying in interest. If that's different than the market rate, where that's made up is in the upfront discount. So another statement might be, Treble Corp receives $950,000 today in exchange for these bonds based on this scenario. Is that true? No, it's not, because we would have to receive less money today to make up the difference in the interest payment. Okay. Another statement might be, instead of saying Treble Corp has to pay 10% per year on this $950,000, we might say, well, Treble Corp has to pay 15% per year on this $950,000. The questions from the book that the publishers like to write have ones that may seem like they're right. And that one, you look at the number, you say, well, I see 15% there, I see $950,000, maybe that's right. But no, it's not, because whatever it says on the bond is the interest that we're paying. Again, the difference between the market and what's on the bond is made up upfront in either a discount or a premium paid for these. Okay, so it could have been any one of those, assuming you knew whichever way, whether those were true or false statements I was making. Those are going to be similar to the statements that are made on that one. Okay, question 2. Company has outstanding bonds with a par value of $200,000. There is a remaining unamortized discount of $15,000 when the bonds are retired by the company purchasing them on the open market at 95. What is the gain or loss on retirement? Okay, in my lecture I didn't really talk about some of this terminology, so I'll go over it real quickly here. When we say a company or anyone is purchasing on the market at 95, that means 95% of the par value. So in this case, that would be $190,000. What that means is you give someone $190,000 now in exchange for this promise to get interest over the next 10 years, and at the end of the 10 years, the $200,000. Okay, in this case, it was a company buying its own bonds back, so that company's obviously not worried about the interest payments. What that company's trying to do is save themselves from having to make those interest payments. So they're buying it back up front. So what is the gain or loss on retirement? Well, how do you figure that? Well, first thing you do is look at the carrying value of these bonds. Okay, what does that mean? That means if you went out in the marketplace today, if when you sold these bonds originally, you had to sell them for a discount because of the difference between the market rate and the stated rate on the bonds. So when you did that, everything, the difference between the par value and what you actually got, was lumped in this discount account. Okay, and as time passes, we reduce that discount amount periodically with the interest payments because we're treating that as part of the interest payments. What that means is, as time goes by, the amount of the discount is reduced, and theoretically what that means is if you did this during the middle of the bond, the amount that's outstanding on the bond should be somewhat similar to what the market rate is. That's the theory behind that. Okay? But what you see here is the actual market rate is $190,000 because we bought these for 95% of the par value. But on our books, they have a carrying value of $200,000 minus $15,000. Okay? So on our books, we look at what the par value is. We look at how much is left in the discount account, and when you subtract 15,000 from 200,000, you get 185,000, and what that's telling you is essentially the carrying value of the bonds. Or in other words, if you related these to other types of assets, this would be essentially what the book value is of the bonds. So if you go out and buy bonds or retire bonds for a lesser amount than that, you recognize a gain. If you had to pay more than that to get the bonds and retire them, you recognize a loss. So in this case, the carrying value was $185,000. We had to pay $190,000, so we would recognize a $5,000 loss on that transaction because that's the difference between what we had to pay and what the carrying value on the bonds is. So the answer to this question is $5,000 loss. But I think there might be two questions like that on the quiz. And for both of them, whether it's a gain or a loss, all you're doing is comparing the carrying value of the bonds to what you had to pay to purchase and retire them. And if the carrying value is greater, then you will recognize a gain. And if the carrying value is less than what you had to pay, then you will recognize a loss for the difference. Okay? All right, question 3. On January 1st, $500,900 of par value bonds with a carrying value of $485,000 is converted to 5,000 shares of $90 par value common stock. What does the journal entry look like for the transaction? Okay, so when we have a carrying value of $485,000, what that means is we have on our books $500,900 in our bonds payable account, and then the difference between $500,900 and $485,000 we would have in the discount on bonds account. So when we got rid of the bonds, however we do that, whether that's through changing them into stock or some other way, we want to get rid of both the bonds payable account and the discount on bonds payable account. So you would have the bonds payable account has a credit balance. So you're going to want to debit that account. Okay, and then the discount on bonds payable has a debit balance, and we're going to want to credit that to eliminate it. I left a space in between those because you want to make sure you're leaving space if you know this is not going to be the only two components of your journal entry. Okay, so the difference between those would be $15,900. And I got that just because I looked at, okay, if the carrying value is $485,000 and the par value is $500,900, the difference between those two has to be the discount that's still remaining. Okay, so I just subtracted the bonds payable from the carrying value, or the other way around, the carrying value from the bonds payable. Okay, so far what I've done is I've eliminated the bond side of this transaction. Okay. Now I have to record the stock issuance side of this transaction. Okay. So I'm going to have common stock, and I'm going to have, and I should probably, hold on. Okay. Okay. So I have common stock, and to figure out what I put in the common stock section of this journal entry, all I do is multiply the number of shares times the par value of those shares. So I have 5,000 times $90 should give me what? 450,000. Okay. So my paid-in capital in excess of par is going to be the difference. In this case, that's the last component of this journal entry. So all I have to do is add up my credits and see, excuse me, the difference between my credits and my debits, and that amount is what I'm going to put in paid-in capital in excess of par, because we're treating the full carrying value of the bonds as the market value, essentially. So if they had given us cash for the full carrying value of the bonds, the credit side to show the stock issuance would be exactly the same. Credit common stock, credit paid-in capital in excess of par. Okay, so this is $35,000. Okay. Anybody have any questions on how I got that one? Obviously, this is a much simpler question if the par value of the bonds and the carrying value is the same. Okay? If that's the same, then you don't have to worry at all about the discount. And all you do is debit the bonds payable for whatever amount it says, and then you handle the common stock and paid-in capital the same way. Just balance it out that way. Excuse me. Okay, question 4. On July 15th, the $48,000 3-year installment note payable. Let's go ahead and pass this around. 3-year installment note payable is issued by a company. The note requires equal payments of principal plus accrued interest be paid each year on July 14th. The present value of an annuity factor for 3 years at 9% is 2.513. What will the payment be each July 14th? Okay. Really, if when I had gone over and pulled out these questions to work today, if no one had taken the quiz yet, I actually would have pulled this question because it's a little more complicated than I would have liked to go into in principles. So I'm putting it on here just so I can basically tell you exactly how to do it, and y'all can get this right, okay? And I'll explain briefly how they got this, but basically we're not going to talk a whole lot about annuities and the time value of money any more than we already have. But essentially, if you just look at an annuity table and plug in the time frame and the interest rate, they give you this present value of an annuity factor. So all you'd have to do is look at the table and look at the time frame and the interest the interest rate, and you would get 2.513. So all you have to do for this question is divide 48,000 by is that right? By 2.513. What does that give us? I think that's right. Make sure it passes the sniff test here. Okay, so, yeah, that looks right. So you just take whatever factor they give you. You don't have to worry about the time frame, the percentage rate, because the quiz will give you the annuity value. Just take the annuity value and the principal and divide, and that gives you what the payment is. Then if it was also asking you, and I think there might be another question on here that I do this on, but if it was asking you also to look at, okay, of that payment, how much of that's going towards principal and how much is going towards interest, well, you would just look at the principal, $48,000, times the annual rate, 9%, and that would give you how much interest has to be paid that year. Okay, whatever's remaining after the interest is paid would be going towards the capital, the principal. Okay, so interest, just remember, you calculate interest first, and then whatever's left over, that goes towards the premium. And then so obviously as the principal gets smaller and smaller, the amount of interest you pay each year gets less and less, and the amount of principal you're paying gets more and more. So you see with loans like this, as you get towards the end of the loan, it accelerates in speed as to how fast you're actually paying off the principal because you're paying less and less interest as time passes. Okay, question 5. Johnson Company issues 10% 20-year bonds with a par value of $900,000 that pay interest semi-annually. The current market rate is 9%. The amount of interest that is owed to bondholders for each semi-annual interest payment is what? Okay, this is similar to one we already looked at in that we issue these bonds. They are actually going to sell for a premium because we can ask people for more money than we're going to pay them back because the bonds pay more than what they can get in the market rate or in the marketplace right now. So that's the fact of this scenario. So what they're asking is basically the crux of this question is which interest rate do I use? The 9% market rate or the 10% rate on the bonds? Well, you always, when you're calculating interest on bonds, you always use the rate that's on the note, that's actually on the bond. Okay? So, in this scenario, you're going to use 10% times 900,000. That gives you the annual amount of interest that you're going to have to pay. And so, obviously, if you have a semi-annual payment, you'll just divide that by 2. Okay? So, in this case, that would be $90,000 in interest per year. Divide that by 2, and that's $45,000. All right, last question here. And like I said, the only thing that I have not, the only topic from the quiz that I haven't covered are any of the questions, and I think there's one that you just plug in numbers as the ratio, where it just says, okay, earnings per share or whatever the ratio is, do you know how to plug in the numbers given to you to get the right ratio? Okay, I expect you guys to be able to figure that out on your own. Okay, number 6 here. Sunny River, July 1st, Sunny River Resort borrowed $270,000 cash by signing an 11-year 9% installment note requiring equal payments each June 30th of $45,000. What amount of interest expense will be included in the first annual payment? Okay, so this is similar to what I was saying in question 4, where we're given, well, in question 4, you were asked to figure the yearly payment. Well, in this case, that's given to you of $45,000. Okay, so you need to know of that amount what is going towards interest and what is going towards principal. And like I said, you always take out the interest first. Whatever's left over is principal. So in this case, 9% times 270,000 will give us our annual rate of interest. 0.09, whoops, times 270,000. Okay, that's our annual interest payment. Okay, our annual payment's 45,000. And so if you were asked, well, how much is going towards principal? 20,700. In this case, we're only asked about interest expense. So 9% of 270,000, which is the outstanding principal in the first year of this loan, is 24,300. And that's all you need to do on that question. Okay? Any questions? All right, that is the material that's on the quiz. If you have any questions on any other stuff or you want to look at anything else on here, I think I've posted these questions already on Canvas. If not, I will. And I recorded this, so I will repost this as well. And let me know if you guys have questions. All right? I think we'll probably cover one more chapter before spring break and then review. Okay? See y'all.